Thank you for tuning in. I am your host, Joseph Martin. Hit that like and subscribe button to support the channel and hit that bell icon to receive notifications. All right, guys, we are 2 videos into this series about whole life insurance. And if you haven't done so, I would highly recommend that you watch the first 2 videos before diving into this one. And I'll put links up on the screen and down in the description. Now, before we go any further, this is not financial advice. Read the disclaimer in the description. Let's get to it. Lesson number 1, riders. In the previous video, I briefly mentioned how dividends can be used to fund riders that you can add to a policy. But first, what is a rider? Riders are optional extra features that you can add to your policy. Let's go back to our car analogy. A policy without riders would be like purchasing a base model of a vehicle. There are no extras. Why? I'm glad you asked. Because extras improve the performance of the vehicle and enhances the experience for the driver and the passengers. Adding extra features increases the value of the car, which explains why vehicles with more cost more. This is similar to what happens when you add a rider to a life insurance policy to help maximize and unlock the features you wouldn't get otherwise. Lesson number 2, waiver of premium. One of the most common and standard riders is the waiver of premium. This is popular because it's usually marketed to the buyer of a policy that if they weren't able to make the premium payments, that the rider would waive the premium payments and keep the policy in place. This is not entirely true. It can't just be any reason you can't make the premium payments. It has to be what the insurance industry would refer to as a qualifying event. A qualifying event, for example, could be something like a disability that occurs after the policy was in place that prevents you from working. In part 1 of this series on whole life insurance, we explained the 4 roles a person would have in a life insurance policy. I'll put them up on the screen as a quick reminder. Here's something I want you to keep in mind before we talk about owning a policy where the insured role isn't you. This even applies to minors, yes, children, that the insurance company knows aren't the ones making the premium payments. The waiver of premium applies to the insured not being able to make the premium payments after a qualifying event, not the payor, which is the role responsible for paying the premiums. This simply means that if you're the payer of a policy and the insured is someone else, the waiver of premium rider won't waive the premiums if you're the one who has a qualifying event, which means it's possible that you could be paying for the premiums for a policy right now on a child or an adult who has a qualifying event. If that policy has the waiver of premium rider, you could contact your insurance company to make them aware of the qualifying event and submit any proof that they ask for. Some companies have a 6-month waiting period for the disability to remain an issue for the insured. Then they will refund the 6 premiums paid during the waiting period if you pay them monthly and waive any future ones. Which brings us to lesson number 3, Payor Benefit Rider. Now, this is the rider that waives the premium if the payor, the person who is actually responsible for paying the premiums on a policy, has a qualifying event. If you know you're going to have multiple policies that you are responsible for paying premiums on, this might be a powerful rider to have on those policies. That way, if something happens to you, a qualifying event like passing away or disability that prevents you from making those premium payments, the insurance company would step in and make those premium payments for you. If the event is a passing away, the insurance company would make the premium payments until the insured minor turns either 21 or 25, depending on your policy. Because once minors become adults, the insurance company expects them to be able to pay the premiums. After minors who have reached the age an insurance company stops paying the premiums for this type of rider, even if they aren't listed as the payer on the policy, the company still expects them to be responsible for making the premium payments because they're adults. Now, I want you to understand, because the rider is so powerful, they don't just give approvals for it to everyone who applies. The health of the payor has to be considered, since in the event of their passing or any other qualifying event, the insurance company would be paying those premiums. Also, this rider usually has an expiration that could happen before a qualifying event. For example, when the insurer reaches 21 or 25 years of age, depending on your policy, or when the payor turns 65. And if you're approved for this rider, it becomes void if you choose to change owners or payors after the policy is open. And that's because the rider was approved based on the payor at the time it was initially put in force. So don't think you could just change the payor to someone who's disabled or about to pass away after it's been approved and waive the premium payments. Another tip is that if this rider expires or becomes void, you no longer have that feature and you shouldn't be charged for it anymore. Lesson number 4. Paid up additions. Okay, guys, this is the beautiful, beautiful unlocking of some powerful, powerful features right here. Paid up additions, also called PUA for short, is when you use additional funds to purchase more life insurance within your policy. This causes two powerful things to happen. It increases the cash value within the policy and it increases the death benefit. The only difference is where the money comes from. There are two different types of PUAs. There's PUA insurance and then there's the PUA rider. Paid up additions insurance is when you choose to have the dividends purchase more life insurance within your policy. You can think of PUA insurance as automatically increasing both the cash value and the death benefit as long as dividends are being paid by the insurance company. This is a huge win-win, because this happens without you having to make any additional payments outside of your premiums. So you're paying the premiums, but the dividends, which are being paid by the company, are paying for the PUA insurance. The PUA rider, on the other hand, is funded by you. These are additional funds you put into your policy on top of your premium payments. These funds will grow at your fixed rate while increasing both your cash value and your death benefit, which brings us to lesson number 5. Modified Endowment Contract. Since a whole life insurance policy grows at a fixed interest rate, tax-free, the IRS doesn't want you to use it like it's only for an investment if they can't tax you. The life insurance policy has to look like you're using it for whole life insurance and not an investment you're overfunding for the guaranteed returns that the IRS can't tax. Let's go back to our analogy of the life insurance policies being like cars. Think of the premiums you're scheduled to pay as a speed minimum. This is the slowest funding you've agreed to. If you maintain this minimum speed of funding, your policy stays a tax-free life insurance policy. It's important to know that the IRS sets the funding speed. So you can put additional funds and larger premiums in your policy as long as you don't cross this limit to maintain a tax-free status on your life insurance living benefits. Okay. So living benefits are any funds the owner can access from a life insurance policy while the insured is alive. If you start dumping cash into a policy beyond this speed limit the IRS has set for funding, they turn your policy into a mech, which stands for a Modified Endowment Contract. The IRS is essentially saying this is no longer a life insurance policy. It's an investment account. The policy still pays out a death benefit tax-free to beneficiaries, but the living benefits of that policy have all become taxable. For example, if you take out a $10,000 loan from your policy before the age of 59 and a half, the IRS takes a penalty of 10%, which would be $1,000. Then you're going to be taxed on it as income. Depending on where you live, this could be paying income tax on the federal level, the state level, and the local levels, estimating that to be a total of 30%. Here's the crazy part, though. They're still going to apply it, that 30% tax, to the full $10,000 loan you took out from this policy. So after the penalty and taxes, you're going to be walking away with $6,000 of a $10,000 loan, which means you just lost 40% of your loan to a penalty and taxes. Here's the other thing. If you intend on paying back the loan, you have to pay back the full $10,000 because that's what you actually took out from the policy, compared to a whole life insurance policy that doesn't become a MEC. You will receive the whole $10,000 for the loan, penalty and tax-free. Once a policy becomes a modified endowment contract, the IRS views loans against these policies as gains from an investment. That's why it's crucial not to allow your whole life policy to be flagged as a MEC by the IRS by overfunding it beyond your policy limits. Because once that happens, it will be a modified endowment contract as long as that policy is in force. You already know. I hope that you learned something, and I hope that you earned something. Hit that like button and put your thoughts down in the comments. Let me know what you guys think. Make sure you check out my other two channels, Original Greatness Shorts and Original Greatness Uncut. Make sure you stay tuned for part 4 on whole life insurance, and check out this next video. Take care and God bless.